Not all accounts are created equally. Here's where your money should go based on taxes. One of the biggest value adds for clients with whom we work is taking a look at tax location, meaning which buckets are you saving into and which buckets should we distribute from first in retirement. There's three primary buckets that most of your dollars would be invested in, and those buckets are a taxable bucket, a tax deferred bucket, and a tax free bucket. A taxable bucket is a brokerage account where you pay interest each year on dividends, interest, and if you sell, capital gains or losses. A tax deferred account is one that most people are likely familiar with, which would be a traditional IRA, a pre-tax 401k, or like a rollover IRA. And the third bucket would be tax free. So a Roth IRA, or even like an HSA. Now, when it comes to taxes on a pre-tax account, or a tax deferred account is another name for that, you do not pay taxes when you contribute to that account, and you get tax deferred growth on that account. The caveat here is that when money gets taken out of the account, it is taxed at ordinary income rates, and after a certain age, there are required distributions that need to be taken from this account type, and that can increase taxable income later. The other piece of that would be a tax-free account, which would be a Roth IRA, as I mentioned, and that account is where you get to take distributions from the account later on in retirement, as long as they're a qualified distribution, tax-free. However, you do not get to deduct contributions.